The Dutch East India Company used hundreds of ships in the 1600s to conduct international trade in silks, gold, porcelain, spices, and other goods. Yet it wasn't inexpensive to manage such a large company. The corporation turned to private citizens, people who could invest money to support the journey in exchange for a percentage of the ship's profits, to finance their pricey travels. By engaging in this strategy, the business was able to fund more greater expeditions, boosting earnings for both itself and their astute investors. The Dutch East India Company unwittingly created the first stock market by selling these shares in coffee shops and shipping ports all over the continent. Since then, firms have been raising money from eager investors to support a variety of industries. Today, there are even entire television channels devoted to explaining how the stock market works. But compared to its earlier iteration, the modern stock market is far more complicated. So how do businesses and investors currently use the market? Consider a brand new coffee business that decides to enter the market. The business will first market itself to major investors. If they believe the business to be a good one, they get first dibs on investments and sponsor the IPO of the business. This places the business on the formal public market, where any corporation or person who thinks the venture could be profitable may purchase a stake. By purchasing stock, investors become a small stakeholder in the company. Their contribution aids in the business expansion, and as it prospers, additional investors may start to recognize its potential and purchase stock. As the demand for such stocks rises, so does their price, raising the barrier to entry for potential buyers and boosting the value of stockholders' existing holdings in the company. By demonstrating how many individuals are eager to invest in their idea, the company's increased interest both helps fund future initiatives and raises the value of the company as a whole on the market. The opposite can also occur if, for any reason, a business starts to appear less profitable. Investors who believe their stock value is going down will sell their shares in an effort to profit before the company loses any more value. The market value of the company decreases along with the stock price when shares are sold and demand for the stock declines. This might result in significant losses for investors, unless the company starts to appear profitable once more. Many factors affect the supply and demand pendulum. Market dynamics, such as altering labor costs, shifting material prices, and changes in production technology all have an inescapable impact on businesses. Investors may be concerned about shifts in management, negative press, or more significant things like new legislation and trade policies. Of course, many investors are also just willing to sell attractive assets in order to pursue their own interests. Due to the daily market noise caused by all of these factors, businesses may appear to be more or less successful. Also, in the stock market, appearing to lose value frequently results in a loss of investors and, thus, a loss of actual value. Market confidence has the ability to start anything, from financial crises to economic booms. Yet because this element is so challenging to monitor, most experts advocate dependable long-term investing rather than looking for immediate money. In spite of this, professionals are continuously developing tools to improve their chances of success in this wildly unpredictable environment. Yet only the wealthy and powerful have access to the stock market. Since the advent of the internet, small investors can purchase stocks in many of the same methods as institutional investors. And as more people gain knowledge about this intricate system, they will be able to trade equities, support the companies they care about, and pursue their financial objectives. Investing is the initial step. Thank you for watching this video on how the stock market actually works. We hope you found it informative and helpful. Remember, investing in the stock market can be a great way to grow your wealth, but it's important to do your research and understand the risks involved. If you have any questions or comments, please leave them down below. And don't forget to subscribe to our channel for more informative videos like this one. See you in the next one.